This TWINPETES Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the TWINPETES Investing Podcast. This is podcast number 145. And it's the 22nd of January already, 2025. And Henry and I are here. It's 5 to 7. It's a late start. We're going to try and do this one for about an hour or so, see how we get on. We never stick to time or schedules, but it'll be nice to get this one finished off sharpish because I've been struggling today with another bug. And I'm hoping I can budge this one quicker than the last one, which took 4 weeks. How have you been doing, Henry?
I'm very well, thank you, Peter. Very well indeed. No bugs, you'll be pleased to hear.
Say the last bit again, mate. Sorry.
No bugs, you'll be pleased to hear.
Ah, very good. Very good. Nice to hear. Right. So, ladies and gents, thank you for coming back for 145. Thank you all for your generous feedback and comments on YouTube and across social media and on X. Really appreciate your continued support for the pod. And it's lovely to hear your kind comments and your support for the pod, given what we're doing and the hard work that's been put in. We had a conversation, I think it was at Gallon73 was asking you, Henry, regarding how much time you put in for the pod and what goes into the pod. And he's like a little bit shocked as to how much work goes into it for each pod. And it's the reason why not a lot of people do pods. You know what I mean?
Yeah, well, it's an interesting question. You know, I came back with the answer of about 7 to 8 hours per episode, maybe a bit more. It depends on the episode, how much we cover. But there's a lot that goes into it. You've got to research interesting companies for the audience. You've got to read into their backstories, check what the financials look like, check what the forecasts in the industry look like, get your head around what the businesses actually do. And that's before you've started replying to people on YouTube, on X, on Blue Sky. I get people emailing me now, people on the blog writing into me. I love it. You know, I wouldn't have it any other way, but it is a commitment. And I think this is why we've seen so many investing podcasts come and go over the years. They last 6 months and then people run out of energy because they just can't hack the pressure, as it were.
Yeah, it's one of those things, I think. I mean, given the fact I've got to do all the other bits and pieces to get it published across all the different platforms, I'm nearest to 20 hours each pod, which some people go, oh my gosh, that's ridiculous. But if you want to do something to a good quality and you want to do it consistently, you've got to put the time in. And I think the hardest thing that we've ever done really is find a strategy which we are both happy with. Yeah. And that's took a lot of time to just tease and sort it out. And I think we're just about there now. And the next stage will be to try and get it nearer to 60 minutes, I think, consistently, which would be really, really nice. And then we'll just keep going and try and see how we can innovate and grow the audience. I'm going to try and do a few things differently going forward to ensure that we push on regarding the numbers we've got at the moment. I'd like to see us get to about 4,000 per pod. That would be my target for the end of this year across all platforms. And if we can get to that, then I'll be absolutely thrilled. Absolutely thrilled. Yeah. So yeah, I'm gonna continue to work on it. Continue to try and get some additional sponsors and people involved in it. Some new guests. I've got a few people sending me emails going, "Oh, I think this guy would be a really good guest. I think this lady would be a good guest." I'm thinking, I didn't even know you were listening to the pod. You know, institutions and organizations are contacting us and we're going, can this person come on the pod? So I'm going to have some very interesting guests.
Well, I am
going forward.
I'm quite surprised. I get people subscribing to my blog, The Ethical Entrepreneur, and I can see the email addresses as they come in. Most of them are at Gmail, at Hotmail, at Yahoo. Just occasionally, though, I get an at something capital. And I think, oh, that sounds impressive. Who's that? And you go and Google it, and you find, oh, it's a hedge fund, or it's an investment trust, or it's oh, what are they doing reading my work? So thank you to everybody out there from the institutions that's tuning in. Hopefully you don't think I'm a raving lunatic. I don't know about Peter, but hopefully
No,
you're enjoying the
that's me over
writing as
here.
well.
Yeah, yeah. Henry's the sane one. Henry's the sane one. Right, sir. I'm going to give a quick shout out because everyone's not even celebrating this as much as I thought they would be doing. It's almost muted because it's been tempered by Rachel Reeves and Keir Starmer. However, ladies and gents, I'm sure you've seen it. The FTSE 100 broke to new all-time highs on the 17th of January. Yeah, so that deserves a whoop whoop. And then we've gone ebbed and flowed ever since then. And then today, it hit a new intraday all-time high of 8,584 before closing flat at 8,545. So I think that's a bit of an accomplishment considering all the macro noise, negativity, and mess that the country appears and probably is in right now. We're climbing that, what do they call it? The wall of worry
Wall
and
of worry.
negativity. We seem to be climbing it irrespective. And we can't put that all down to the elections in the US. Some of that's got to be some of our companies actually doing some good with good results. So long may it continue. Long may it continue. But I just haven't seen anyone saying we could actually hit 9,000 this year. And who knows? Who knows? Right. So you've chosen a topic, Henry, for us today, which took me a bit by surprise regarding the title of it. So I think probably best if I just leave you to just go with, introduce it. I'm hoping not to cough and splutter all over your conversation regarding this. Do you want to introduce it and tell us what it's all about and why you chose this one?
Absolutely. So the topic we're going to go for today, ladies and gentlemen, is something the core satellite investment approach. And I was thinking about new topics Peter and I could discuss, and we've talked a lot about solid, reliable investments, businesses that have got strong and stable cash flows, they're leaders in their markets, they've got high returns on capital, they pay a good dividend yield, really solid, almost dull kinds of businesses. And we've covered investment trusts, large caps. But the episode today, I want to focus on on a slightly different angle to investing. And before we dive into that, I'd better just explain what I mean by this core satellite approach. Now, it's actually a recognized investing term. It's a strategy whereby, as investors, you can combine a stable core of diversified low-risk investments with some smaller, high-potential satellite positions. Now, the idea behind this model is that the core is designed to provide steady returns and reduce volatility, whilst the satellite, just smaller, riskier investments, should enhance the performance through targeted exposure to specific opportunities or themes. Now, core investments typically consist of broad-based indexes, large cap firms, stable businesses that represent a significant proportion of the market. They're expected to be less volatile. They're not expected to have any sudden shocks. They're expected to provide some sort of ballast and stability for your portfolio. Whereas the satellites are more focused on investments in specific areas, themes, or individual companies that have got higher growth potential. And so I thought on today's episode, we could maybe look at some of these satellite type investments, smaller businesses that you might not have heard of, that maybe are slightly higher risk, but maybe have got slightly higher growth potential. And we could bat some of these ideas around, have a discussion about them, and maybe throw up some ideas that we've not discussed in previous episodes.
Cool. Cool.
So with that said, I'm going to kick off with my very first pick of the episode, as it were. Now, listeners to the show will remember about this time last year, I talked about a business called UiPATH over in America, big process automation company. It was loss-making. It had got a negative capital return on capital employed, but very, very rapid growth. And they provided basically software for process automation, taking people out of repetitive tasks and replacing them with software that does the same thing cheaper, more reliably, and more effectively. Now, the company I want to talk about today isn't UiPath. It's actually a UK alternative. It's a £160 million enterprise software company. The ticker is NET. The company is Netcall. Now, Netcall produces something called the Liberty Software Platform, which is designed to embed intelligent automation and customer engagement solutions to help organizations digitally transform their businesses faster, more efficiently, and empower them to create leaner, more customer-centric organizations. They operate across a wide range of sectors: the healthcare sector, local government, housing, insurance, financial services, rail and construction, all sorts of different businesses. And they basically function as a sort of automation provider. So if you think about a call center, at its most basic level, it's effectively a big room with a load of people in. People can call from anywhere in the world that your customers could call from anywhere into the world into this room. And then these people have got to do something to help them, either process an order, process a request, whatever. Netcall provides software which enables that system to function more efficiently. Either we can take more calls in and get them to the right place, we can process the requests faster and cheaper, or we can handle a greater volume simultaneously. They also provide software for intelligent document processing, so things like council tax issuance. It's a very, very repetitive task to issue council tax. Instead of having one person sat at a desk issuing thousands of bits of paper, you get a machine to do it and to process the returns, track the payments, that sort of thing, answer queries. You've got robotics processing automation, so manufacturing lines that are doing repetitive tasks, maybe attaching doors to cars over and over and over again. 100 years ago, you'd have had a person doing it. Now you can have a robotic arm. Netcall produces the software to power that arm. And finally, they've got one of our favorite things in the world at the moment, artificial intelligence. They've actually got artificial intelligence systems which they are developing to embed into businesses and help them become more automated. Now, the business is profitable. It's got a 16% return on capital employed, and it's got fantastic forecast turnover growth of about 21%. So it's growing fairly quickly. It's forecast to do £47 million in turnover this year, 53.5 million next year. Pays a little bit of a dividend, 1% a year. Not great, but they're reinvesting heavily back into the business to continue that growth trend. And I'm pleased to say that not only are they growing turnover, they're also growing earnings per share, unlike some of the massive US corporates that you see in this space. They've got forecast earnings per share growth of 8.5%, growing from 3.5 pence last year to 3.7 pence this year and 4.1 pence next year. And finally, they've got one of my very favourite things in the investing pantheon. They've got net cash of £35 million. So not too much danger of them going bankrupt. Any thoughts, Peter?
You said my favourite word at the end there, mate. I was like just making notes and looking at stuff, and then you said AI. But also, I think the sticky sort of stuff about the council tax issuance means that they've got, hopefully, if they're doing the right thing, they've got a continual sort of contract which they're managing quite well for the powers that be, and it's one that they've had for a little while and are unlikely to lose it if they're providing a good service, consistent service. So the AI, sticky sort of contracts, the net cash appeals to me. I'd want to know from you, Henry, if you've got the numbers in front of you there, how it's done over the past 12 months in a sense of a return for shareholders. And what do you think that net cash is going to be used for, given the fact that's quite a lot of cash versus their 165 million market cap? That's quite tasty to have that amount of cash sitting there to deploy if you want to. Are they going to be, because they're quite an acquisitive company, aren't they?
They are, yes. They are constantly buying small, innovative type businesses that they can
bolt on. So they've always got cash on the ready to go. We'll have some of that.
Exactly. Over the last 12 months, they've done very well, actually. They're up nearly 19% in 2024. Okay. They've not had a great start to 25, down 7.5% year to date. I'm not quite sure what's caused that off the top of my head. And they're actually near their all-time highs. So in 2023, they hit a high of looks like about 120 pence. They're currently at 99 pence. So they seem to have bounced off a bit of a ceiling there. But they've had very strong returns. I mean, 2020, they were up 30%. 21, they were up 35%. 22, they were up 41%.
So might be just a little bit of a pause at the start of the year. Then other people looking for best, momentum moving stocks, and that can quickly change. When's the next update, Henry? Do you think? Have you got any notes on there?
You've got some great questions for me this evening. Let's have a quick look at shares.
Sorry, mate. Because what I'm hoping is that
if the next announcements due in March, 6th of March.
So not long then. Yeah. So that's good. So for those of you that are interested, I keep an eye out regarding Netcall, because it sounds like they've got a few ducks lined up there. And if the numbers are good in March, I think that minus 7% year to date will be wiped out very, very quickly. And the momentum will be triggered, and people will be wanting to buy that. That's a lot of cash to have. And it's not too big for someone else to go, you know what, you guys have got some nice contracts there. You're getting into the space of AI. They could end up being the bolt-on. You know what I mean?
The funny thing, if you look at someone like UiPATH, the retail audience and the finfluencers, as they're called, I don't know if we make the grade of finfluencer, but they love UiPATH. They're obsessed with it. Stratospheric growth, fantastic business, but it's never made a profit. I don't think it's going to make a profit anytime soon. And it's incinerating cash to grow. And you compare that to something like Netcall. Now, fundamentally, they're in pretty much the same space. It's just that Netcall is smaller and doing this profitably and still growing, whereas UiPATH, it comes back to that idea of selling pound coins for 50p. You'll have loads of customers, but you're not going to last long.
Yeah, absolutely. That's the danger, isn't it? I think the other thing I wanted to say as well is that with regards to the core and satellite sort of strategy, it's about how much you would deploy into these smaller sort of entities at the bottom end of your or the periphery of your portfolio, because you've got some core holdings, FTSE 100, FTSE 250, and when you're going further and further down in these peripheral sort of stocks, which are satellite sort of smaller holdings, I mean, what sort of weighting would you give to that sort of thing if you were, what's the equivalent in your portfolio, for instance, on what you got in there?
For me, I'm very cautious with things like this. I'm wary of small caps. So I usually start at a position weighting of about 1.5% of my portfolio.
Okie dokie, yeah. Less
than that if the business is unprofitable. So I made an acquisition of an unprofitable business last year. If you trawl through my social media, you'll find it's a little chip designer. I don't want to overweight that. You're not going to find me loading up on that every week, no matter what the price does, because it's a risky play. That it's got potential, but it could go either way. And so these satellite type businesses, to me, you don't want more than sort of 15-20% of your portfolio at most across a basket of these, because they can turn around overnight. If growth slows down or they lose a major client, it can really hit them hard. So great story, but don't fall in love with the story is my advice.
This is a quick hello to you, our valued Twin Petes investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Absolutely. I must say as well at this stage is that the reason why you'd have a core and satellite strategy is to not have all your eggs in one basket regarding a portfolio of core sort of passive investments. And the beauty of having some satellite stocks or holdings is to outperform the core. Yeah, so you get a little bit of added spice to that stock that may be just upward surprise. But you have to research those smaller, higher risk ones very, very, very well, because the risk is that they could come back and, punch you on the nose, as me and Henry have experienced in the past year or so with some of the stocks. And then to compare, often with regarding this strategy, it's usually the S&P 500 or US Treasuries? Are you looking for what the professionals called a risk-free rate when you're comparing or looking for a benchmark as to how you perform? So it's not about blowing the lights out. We spoke about what you should benchmark yourself against. And I'll repeat what I said in the last pod. You're benchmarking yourself essentially against what you performed or what you returned last year. 2024, compare that in 2025 and see how you go on. Forget about everybody else. Right. Okay, Henry, thank you for that, sir. Enjoyed that. I think it's a stock that we've probably spoken about before and probably need to look at again. And it's one, given what you've just said about the stickiness of the contracts and the AI bit, which I wasn't aware of, by the way, that there must be a new recent thing. Because I tried to, to screen through all the minutiae of what's got AI involvement. And other people were shouting at screen going, but Pete, you can't just go after a stock because it says AI, because everyone's going to be mentioning AI right now. And that's true as well. So I've got to be mindful that companies are sticking that on the, on the data that's sticking out, on the literacy. Right, literature. I'm talking about the next stock. I'm just giving it away already. Damn it. Right, I'm going to talk about a private equity company, Literacy Capital. The ticker is BOOK. Literacy BOOK, BOOK, and it's a closed-end investment company. The team's core focus is investing in private businesses where a clear route to create an individual value can be seen with their support. So they try and do a lot with engaging with management and so on and so forth. And the reason I want to speak about this one, and it caught my eye, given what I do and Henry does as well, is that they've got a unique objective. And this goes back to the conversation we were having with Joe Ingham as well about, social awareness and raising money for charity. And they've got this unique charitable objective, which they actively support regarding what they do. And over the period of time, since its creation of this particular closed-ended investment company, they've generated and donated or reserved for donations to charities £10.6 million. So I was like, that's interesting. That's really, really good that they're doing that. So that's why it caught my interest. Essentially, they're always looking to invest in businesses where there's a possibility for the shareholders to discuss the future. Yeah, so they want to be able to speak with the owners of the businesses, sit down with them and have a chat. They don't want to just take a stake and just sit back and let the management get on with it. They're looking for innovative companies and they're looking to help them accelerate their growth and accelerate the value of their companies. And the teams tend to engage with some of the companies and the businesses on a day-to-day basis once they become shareholders. So that's what I like about the particular company. They haven't done so well in recent times. The particular share price at the moment is sitting nearer its 52-week lows. The NAV is £5.04, just over that. And the share price currently is £4.40. So that's a discount of 12.8%. The 52-week range is 4.28, so it's sitting right near the low there. And the 52-week high is £5.35. And they had a quarterly trading update on the 28th of October. And the NAV was down slightly for the quarter by 3.4%, or 17.9 pence per share. And that took the NAV down from previously £5.22 to the 504.7 that I just spoke of. But what they said at the time was that the majority of their largest holdings continue to perform in line or ahead of plan, despite the UK business confidence and growth remaining subdued. And if you look back at October and November, the markets were horrible. They weren't that great for the UK. They didn't perform very, very well. They've got their next update due, and this is why I pulled it out, on the 29th of January, right? So next Wednesday morning, they should be coming out, give or take a day. I'm going to say 29th. They should be coming out with a next quarterly trading update. Discount to NAV, given what's going on regarding all the Sabbath stuff and all the other companies that individual and the companies are going for, I think there could be a catalyst for this private equity company. If it comes out next Wednesday, Thursday, and says, our NAV hasn't fallen, and in fact, it's increased by X amount of percent, and we're on the trajectory to exit another one of our larger holdings, I think the share price could do quite well. On a 1 year total returns basis, it's down 11%. I think that could easily just go like that if it comes out with really good numbers next week. And a lot of the stuff that they're involved in are tech related companies as well. That's it, Henry. That's me. Boop.
Well, you missed a very important thing that caught my eye with this one. Maybe you've done it deliberately. So I've never heard of this business before, and I looked at it and I thought, oh, is this some sort of education business? What is it? Oh no, it's an investment trust. Oh, it invests in UK businesses. What do they own?
Only UK businesses, 100%
UK
private
businesses.
equity. Yeah.
But the thing that caught my eye wasn't the fact that they only invest in UK businesses. It was their 3-year annualized return. So their rolling 3-year annual return on their net asset value, they've grown their net asset value by 22% a year for 3 years running. That's pretty impressive. And the investment trust itself has generated an annualized return of 12.3%, which, again, pretty impressive. And this is a business I have never, ever heard of. I've not seen it in the papers. I've never come across it. My only, sort of bearish thought on it, the expense ratio seemed a little high, 1.3%. So I'm going to pay this management team 1.3% to go and pick businesses, unlisted businesses, grow them, sell them on. That's fine, but I don't know why they'll do it any better than anyone else will.
You've just answered that bit because they've just given you the total returns. That's been compounded like a madman.
And this is the problem I have with investment trusts. I'm very good at looking backwards and going, oh look, they've grown this 12% a year for 3 years. As soon as I buy them, the management team seems to lose all their ability to do this, and the share price just falls off a cliff.
Don't trigger me, mate. I'm struggling here. Don't trigger me, please. It's not just you that just buys them and they fall, mate, and they fail. We've all been there. We've all got.
If anybody out there has got a sensible methodology for buying investment trusts that doesn't lose them a bundle, please let me know, because I've been burned so many times with investment trusts. I don't go near them.
Mate, I think if it says infrastructure, and it also says 25 to 35% discount, and it's currently yielding more than 6%. I think you've got to tread very, very carefully, because that discount could stay where it is, and that actual yield could disappear. Buying solely for yield has been a recipe for absolute getting a shellacking over the past 2 or 3 years. And some people will go, oh, it's got this yield and that yield. There's other stocks out there that are not infrastructure related, property related sort of trusts that are yielding just the same. And you know what? You can get a capital gain on it because the share price won't spank you and withdraw the dividend cover, the dividends, full stop.
I also like the fact that it's actually investing in real businesses in the UK economy.
Oh, I thought you were going to say UK businesses. I like the fact it's investing in UK businesses, Henry.
But the last night I was out for a few sherbets with my friend David, and he pointed out a business to me and he said, have you ever come across this one before? Now, it's not a listed company. It's called Community Clothing, but it was founded and run by a guy called Patrick Grant, who I've followed for years. He's a Savile Row tailor. And you'd think to yourself, oh, Savile Row, all right, a suit for 10 grand sort of thing. Not at all. Patrick Grant was taken on by Debenhams. He did an affordable range of Savile Row quality tailored clothing for the everyday person, because he believes that quality shouldn't be the exclusive preserve of people with an enormous bankroll. I used to love his stuff. Anyway, Debenhams goes on the line ended, but he's now got this thing called Community Clothing. Same principles, Savile Row quality. It's all about top quality British manufacturing. He's up in Blackburn in Lancashire.
Wow, okay.
And my friend David, he said to me, he went and he bought like 3 factories for £1 or something. They were going into receivership. He's turned them around, local manufacturing, real people making real clothes for, real communities. I mean, this is fantastic. This is exactly the sort of thing we need more of in this country. Less people pushing bits of paper around, more people doing
making
jobs.
Stuff, doing stuff. Absolutely. You'll have to send me that link, Henry, to that particular firm. because we have loads of young people that we engage with in and around various different communities that we're always struggling to clothe for interviews to make them have something suitable. They can't go to an
Yep.
interview with hoodies on or trainers. So getting them a nice, reasonable suit with nice pair of trainers, nice pair of shoes is all good. And occasionally we can even get them to wear a tie, which is it's a struggle, but we like that.
It's a rare thing these days.
I don't want to wear one of them. Yeah. Standards are slipping. I mean, just look at me compared to you. So you've got your tie on and your shirt. Right. Okie dokie. So book literacy, Henry. Interesting one. I think the catalyst could be the next trading update, for good or bad, on the 29th. If it comes out with a reasonable good update, I think that could be the catalyst. It's sitting nearer to its lows at 440-ish. And yeah, £264 million worth of private equity waiting to the valuation much higher. Discount's only 12.8. I must say as well with this one, there is no divvy. Yeah, that was the other one. So you're not getting paid while you wait. You're waiting for them to actually push through.
Nice.
Okie
I like
dokie.
it. I like it.
Cool.
Well, I will see your investment trust, and I'll raise you another small cap actually. So this is one that
Okie
some of
dokie.
our listeners may be familiar with. I've seen the ticker floating around. I'd never really looked at it before I started doing the research for this episode, and when I did, I was incredibly interested in it. It's very similar to another business I already own in its sector. That business has done particularly well. It's very well run, great management. And so this has got a lot of the same hallmarks of quality. I just don't know the management team and I don't know the business that well. The company is Filtronic PLC. The ticker is FTC. And they design and manufacture a range of customized radio frequency, microwave, and millimeter wave components and subsystems. Now, these are products that are used in mobile wireless comms equipment, point-to-point communication systems, and have defense applications as well as civilian applications. Now, their customer base includes a lot of international, what are called original equipment manufacturers. These are people that make their own equipment, basically, and sell it on, use it, as well as a wide range of mobile phone network operators. So you think of people that have telephone masts, internet masts, run radar systems, satellite systems, lots of different sectors, lots of different applications. These guys produce the components and subsystems that enable those to work. They've got 4 sites, 3 in the UK and 1 in the USA. They've got some great quality metrics. I mean, they're 23% return on capital employed, which, I like to see at least 10% in the businesses I invest in. I don't always actually achieve that, but that's sort of my cutoff. So 23% is really very positive. They've got strong forecast turnover growth. And again, if you think about this as a satellite holding, growing at 79% their turnover, even if that halved, but maintained its sort of upward trajectory for 3 or 4 years, even at half that rate, at 40%, this share would be significantly more valuable and the company would be significantly bigger. And they've also got a 231% forecast growth in earnings per share. So this isn't a business that's going after customers and burning cash to do it. It's profitable, it's earning revenue, and it's going to be earning a lot more profit this year, next year, and the year after than it was in the past. So one of the things I like to look at with these satellite type holdings, it's no good hoping that next year they're suddenly going to become profitable, because more often than not, that never happens. I like to buy businesses that have already demonstrated they can do what they do profitably, and they can grow whilst doing it profitably. So this is one that really caught my eye, actually. It's really interested me.
I was waiting for the punchline, Henry.
There isn't one.
You left the punchline out. I left out the total returns. You've left out the punchline. They've got a massive or ongoing relationship with Elon Musk and SpaceX.
Oh, do they?
Yes.
Well, I missed that one in my.
And that's what everyone's been going. Everyone's been like that for the past year and a half, going, "Oh, let's
Oh,
jump on
ladies
board.
and
Let's jump on
gentlemen.
board." And because it was a former tech darling going back to the 90s to the 2000s. One of them stocks that was, if you pull up a chart for it and go all the way back to 1990s, 2000s, is one of them that was way up there. You know, a proper tech
Right.
darling, absolutely priced to perfection. And then
Right.
it just went wallop all the way down. If you look at the recent lows in the past 3 or 4 years, it's significantly below where it is now. What is it, at a pound or something like that? I don't know.
Oh yeah,
I
I
haven't got
mean
the
it's
price of
95 pence at the moment. If you go back
right.
5 years, it was at sub 20, sub 10, I think.
Sub 10 pence. Going back further beyond that, what was the price?
Well, that's as low as I can see. So I can only see the price going back to 2020 here.
Right, so 20, no, so all in 2020. But the share price was significant back in the day, mate. Back in the day. But they've got a huge ongoing conversation and relationship supplying and working with the SpaceX. And that's what people have been galvanized on over the past
Right.
year and a bit, and jumping all over it. The share price has gone from
Well, it's
January
gone from 10 pence up to
2023
99.
at 22, 25 pence,
Yeah.
and currently sitting at a pound. So over fourfold in the past essentially 2 years. Yeah.
Yeah.
And I've gone when I saw it at 70 pence and everyone was talking about it, I was like, I'm not chasing that. Yeah. And it went to a pound. It's just come back a little bit. But it's one of them where it's a fantastic company, but it's another brick company which always had everyone had really high expectations of it. And then it had a bit of a and the share price literally just kept going that, and everyone's like, when is this going to end? You know, almost to the point it was going to go out of business, Henry. But January 2023, the catalyst started, and since then it's been popping. You know, and going to I think the
Yeah, you're right.
13th or the
Actually, I've
14th of
just gone on Google. If you go all the way back to 2000, this was £20 a share.
there you go. There you go.
Wow.
From
Wow, wow,
£20
wow.
a share to 10 pence per share. That's how big a darling it was to how fall from grace it had. And it's being reignited now regarding the relationships with not just SpaceX but other companies.
Yeah.
Hence the reason why it's gone up fourfold in the past, more than fourfold in the past 2 years nearly. Phenomenal run. But it came out again on the 13th, I think. And the trading update was again saying we're trading ahead of expectations. So the momentum is there. You know, all that negativity is just long gone. And
It's gone
people will
absolutely
chase this.
parabolic. I mean, it was up
Yeah.
250% last year.
Well, there you go. And other people will carry on chasing it.
Yeah.
Yeah, there were people with buying it at a pound, buying it at £1.10, because all it needs is for other contracts to come on board. But there's a question here because who was I speaking with? And I hope he's listening. Peter Hunking, lives in Leicester. The other Pete, he said, I'm the Pete from Leicester. I'm like, no, you're not, mate. Met him at Mello and had a chat, and he's into his tech, and he was saying the only danger here is that, as we all know, Elon Musk likes to own stuff. Yeah. So there could be a situation here where at some point he goes, I'm not sure what the market cap is of Filtronic, but he just goes,
200
yeah,
million.
we'll have 200 million. Yeah. Yeah. He's made that in his sleep just the past few days since
Just on his
the inauguration. Yeah. He just needs to just create a MUSK coin and get himself 15 billion, and he can just buy the whole of that and more times 100. So yeah, so that's the caveat. Potentially gets taken over, other contracts come, it could just carry on. Will it ever get back to 20 quid a share? Who knows? Could
I
they come out with
wouldn't
a
go
warning?
that far. I definitely.
Could they
I
come out
had
with a warning
no
and just
idea that this
halve
went back
and
that
halve in the
far.
next 6 months or year? Who knows? Yeah, but right now it's one of the quality companies that we've got that's innovating and working in the tech space and supplying OEMs with the kit that they need, and it's doing extremely well. So UK, long way continue. Good stock, mate. Good call. Good call. Good call. And you know what? Lots of people on FinTwit, on X and elsewhere like that stock. I think there's a chap called, is it Pat Vieira? Pat, that's on. Sorry, is it Pat Vieira? Yeah, Pat Vieira. It's Nick. Nick has got a chunk of change in that. So he'll be pleased with you speaking about that particular stock. Good call. Good
It
call, good
definitely
shout.
caught my eye. It's one of those that I had no idea about the history. But again, this is the benefit. And again, for members of the audience that are new to investing, don't be afraid to go and talk to experienced investors like Peter, for example, because they know the history of so much of the market and they can point things out to you. Someone mentioned to me the other day about this chip manufacturer I'm in, and they said, "Oh, go and have a look at the chairman and see where he's been before." I've got no idea, absolutely none. Now, I'll let people go away and do a bit of reading on their own, but the point I'm getting to is that you can do all the research in the world and you can read all the annual updates and think you've got the full picture. And then you'll talk to someone like Peter and they'll go, "Did you know this used to be £20 a share, etc., etc." What interesting context, useful to know. So, yeah, valuable.
And I appreciate your kindness by saying that, Henry, that you use the word experience, not old and knackered and a fogey. But thank you for those kind words, and not using old and falling apart. Right, should we take a break here, Henry? I'm just going to quickly tell people about the Menphys fundraise. We'll have a little break here.
Yes.
Because we started it 2 weeks ago, ladies and gents, on the last pod. Henry had done phenomenally well with Centre Point and smashed it out of the park, and we got over 6k for Centre Parks. And you guys were and ladies and gents were ever so generous with that. We start again with the new year, and I've chosen the Menphys charity, of which I am an ambassador for. They work with disabled children and support the families, etc. Part of what I'm going to do this year is not only doing the podcast with Henry, but additional to hoping that you guys and ladies will support me with the pod, is I'm going to be doing some additional volunteering with the organisation and raising of awareness up and down the country regarding Menphys. And I've been doing that since the start of the year. And on Sunday we had our first Sensory Sunday, we called it, and it was a bit of a break for the families. It was for all the kids that have got any sort of additional needs, special educational needs, sensory impairments, and so on and so forth, and their siblings to come. So we ended up with having the hall sorted out. We had a bouncy castle in there. We had the sensory room open. We had the coffee shop open. And I didn't tell the CEO that I was going to be coming. And his face when I rocked up was like, oh, because literally there was all these families, and the CEO, his missus, one member of staff. So when I rocked up, he was like, oh, like that. But I think that's where I picked up my cold and my bug now, because there's all these kids and running around, and I must have done X amount of miles just running after, because you see an exit that's open. Kids just go, forget about the bouncy castle, forget about the sensory room. They want to just get out of the building or try and find somewhere to hide from their parents. It was good fun, but it was absolutely exhausting. But we've got loads more of those sort of sessions we're going to put on throughout the year. So I'll be volunteering at most of those. We've got other after-school clubs we're going to be doing, so I'll be trying to get to those as well. And invariably, I'm going to be doing lots more with them. So if you can support me regarding fundraise, please do so. So we started it 2 weeks ago. We're currently sitting at £350 thus far. You can find it on the Just Giving page, and just search in there the TWINPETES Investing Charity Challenge 2025. And thus far, we've had donations from Matthew Gregory, and his words were, "A new year gift. Wonderful stuff, gents. Keep being a beacon of kindness. Feels like Pete should post his Santa video if we hit the target." Well, that's a possibility, Matt. Thank you very much. So that was £25 and £6 gift aid. Thank you, Matt. JMC, we'll try and remember to donate throughout the year. Thanks for the excellent podcast. Thank you, JMC. £20 and £5 gift aid. Trader Mark 72. Nice one, chaps. A great charity support, and thank you for all your hard work. £50 and £12 gift aid. Thank you, Mark. Much appreciated. Our very own Henry Viola Hare here. Proud to be supporting this cause as your co-host on the Twin Peaks Investing Podcast. We're behind you all the way. Thank you for that, Henry. £100 and £25 gift aid. Very much appreciated, mate. Then we had Up the Toffees. Keep up the charitable work, guys. Eagerly awaiting your investment wisdom in 2025. He could be in for a long wait, couldn't he? Eh? sorry, Up the Toffees. He could be in for a long wait there.
Glenn. Put it all on red.
Yeah. He's added there, he's put, like putting all your eggs in the meme stock basket. Truly the philanthropists we need. £20 and £5 gift aid. So thank you all thus far. And please head to the Just Giving page, www.justgiving.com/page. Peter Higgins, you should be able to find it from there on. And let's get this moving on. And let's get to £1,000, and then we can start pushing on for 2 and so on and so forth. Just donate what you can, ladies and gents. And, you know, I can then talk about it and with other people in the city as well. And also with the families I'm speaking with now, it's going to be on a daily, almost weekly basis, speaking with some families about the fantastic people we've got that listen to this pod.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks Investing Podcast listener, you can access an exceptional offer from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe today using the Twin Peaks promo code, and you can save up to £69. Visit sharescope.co.uk for further details and subscribe to the investing and trading analysis and data you need.
Right, Henry, do you want to do another stock, or do you want me to share with you my next stock?
I've got another one for you, Pete. So this one is totally left field, right? And I'm scrabbling around, I'm looking at ideas, I'm turning over rocks, I'm trying to find something interesting that listeners might not have heard about. And I came across an absolute tiddler of a company. It's a £24 million market cap company. So, you know, real fledgling here. 24. They're engaged in the provision of tyre management solutions. These are the things that go around the wheels on your car.
Not just me doing that, you mean?
Yeah.
Too tired to manage, sort of thing. Sorry, folks, I couldn't resist.
The ticker is TRT. It's Transense Technologies.
Transense.
They develop, manufacture, and sell specialist tyre probes and the Transense tyre pressure monitoring technology. The company has developed a range of sensors and what they call electronic interrogation systems for measuring pressure, temperature, and torque in automotive and non-automotive applications. I don't know how many ways you can find to say we check tyres on wheels, but
usually you start the car, you go like that, you go, I think I've got a flat. That's it.
Yeah, I've got a wheel, it's attached. Like, what more do you need to know? Anyway, they've got a range of technologies, Translogic, SAW. They've also got something called the iTrack business, which they sold off and they now get a royalty from. And that royalty seems to be growing exponentially when I looked at their revenue. They derive the majority of their revenue from Europe, but they've also got a presence in Chile, Australia, the UK and North America, Japan, and small bits and bobs around the rest of the world. Now, the reason this one caught my eye, again, if we're thinking about this core and satellite approach and we're going for something that's a bit spicier that might have some growth potential in it, their growth trajectory since 2020 has been absolutely phenomenal. They've grown their revenue from less than £1 million a year to over £4 million last year. They've 4x their revenue. They're on a forecast PE of just 14.5, so not particularly expensive. They've got a great return on capital, again, 26%. This is a profitable business. And they're quite bullish about their growth opportunities. They think they've got strong opportunities to expand sales with their existing global customer base. They're developing new direct sales channels to tyre manufacturers, service centres, and fleet operators. And there are thousands of these around the world that they're not engaged with at the moment. And they're also establishing new distribution partnerships with territory distributors and niche software developers in the defence and the Formula One race car testing space. Now, on its own, you might think to yourself, why on earth would I want to own a tyre manufacturer? But if this carries on doing what it's doing, imagine how much more valuable it could be if it 4x's again from here, 4 million to 16 million revenue, 16 to 64 to 120. The growth potential on this is huge. Think how many vehicles there are on the road. Think how many planes there are in the sky that need the tyres checking, etc. And presumably this technology can also be developed and applied to other industries. They've just not spent the R&D successfully yet in order to develop those technologies. So this could be a real little hidden gem in the British manufacturing and testing industry that could go on to do great things. And it just caught my eye as quite an interesting business I'd not heard many talk about before.
Yeah, it's one of those, mate. Anything to do with advanced driving technologies will get the attention of investors. And it's done exceptionally well, as you say. It's had a really strong 2024. And it's just come out with in-line numbers. And it says trading update, in line. However, revenue was up 37%. So were they expecting a revenue to increase of 37%? I mean, that's incredible. So yeah, it's one of those, Henry. As a small technology company, I would normally be all over it. And you've added to that sort of me going like that, because you mentioned not only Formula One, yeah, and advanced driving technology, of which there's more and more cars coming on that need this, and there's automations coming on regarding all of these car stuff. So they need even more embedded tech in the car. But you also mentioned the defense space. Given my fears, maybe unwarranted, of other stuff that's going on in the world, they've got a lot of different I couldn't resist. Spokes in the wheel, Henry. Yeah, you see where I went there? Of income streams that they could possibly tap into. So if one subsides or one doesn't do so well, they've got another one that could be growing potentially to offset another one that's having difficulty, and it's still tiny. So there's room. It's always about buying companies where there's room for growth over a significant period of time, not just 1 year or 2 years, but 5, maybe 10. So if they've got that sort of opportunity of growth and runway, then why not? Why not? Very interesting one, that is. And it's only tiny. Has it got any? You're the cash master. Do you say it's got any cash?
It has. It's on net cash of £900,000.
Just shy of £1 million. Well, that's not bad at all, Henry. Don't have to worry about keeping the lights on.
There's a few bits in there that I'd want to go and research it more. You go buying this and you're almost buying your local corner shop. I'm exaggerating a little bit. You've got to be careful with businesses of this size that you really understand what the thing's doing, where it's going. Do you trust management? Go and listen to some management presentations. There are plenty out there. When I was doing my research that you can go and watch, get a feel for what they're talking about. How are they talking to shareholders? Are they trustworthy? Have they said, in 2020 that they're going to do X and then they've delivered it, and then in 21 they're going to do X and they've delivered it?
Yeah.
Or are they missing their targets over and over? Really get a feel for it. And again, be careful with a business like this because it's very, very small and things can go wrong very quickly. So don't go piling into this and putting 20% of your portfolio in because who knows what will happen.
Yeah, it goes back, like we said, about it being a satellite one. So it's a smaller sort of weighted sort of holding, which you could
Exactly.
hold for a few years. It
As,
might,
as
you
a
know,
basket of, say, 10 companies, if you bought 10 satellite holdings for your portfolio, you could put 1% in maybe and just
yeah,
leave it
yeah,
and leave it and sit
yeah,
on it. And you could hold it for 5 or 6 years and watch how they do and gradually top it up as you get more confident with it. And likewise, if you get it horribly wrong and it has a car crash year, no pun intended, if it has a car crash year 1 year, then you're barely losing anything. Even if it lost 50% of its value overnight, you've lost 0.5% of your portfolio. It's survivable.
yeah. I didn't miss the joke, Henry. I heard you say car crash, given the reference to the company. I
I
did
don't
hear
think
that.
our jokes are getting any better, Peter.
They're not getting any better. You know, I've got my dad jokes. You've got your whippersnapper jokes, mate. We're not very good with the jokes. Right. I've got two companies I'm going to whistle through, Henry. I'm going to start with what was a potential takeover company from last year. And that company, and this is why it's on my radar, I think could see the same thing happen again in 2025. The company I'm talking about is TT Electronics. The ticker symbol is TTG. Share price at the moment, closed today at 88.8 pence. And the shares are down around 40% in the past 12 months. Market cap of 600 million. 52-week range of 71 pence to 184. What do they do? TT Electronics provides engineered electronics for performance critical applications. Its divisions include power and connectivity, global manufacturing solutions, and sensors and specialist components. The power and connectivity division develops and manufactures power application products and connectivity devices that enable the capture and wireless transfer of data. And I think that's what attracted Mr. Rothschild of Volex last year. Do you remember that, Henry? The approach of that?
Yes, I'd forgotten about
That's what
this. You're
happened.
right. They did. They had a takeover
Yep.
offer, didn't they?
Yeah. So September of 2024, they came out with a profit warning and the share price got absolutely spanked. And the share price continued to drift, eventually hitting 71 pence. And the shares were then at a, wait for it, 15-year low of 71 pence, Henry. And given they do sensors and specialist components, and geographically they're in Europe, North America, and Asia, which fits nice and tidily with what Volex do. They were approached by Volex in November, and one offer we didn't hear about until the second offer came out, as far as I'm aware. And the second offer was 62.9 pence per share and 0.223 new Volex shares per TTG shares, with an implied value of 135, which was rejected. Bearing in mind the day before that this offer was made, Henry, the share price was 79 pence.
So they were
They
willing
got
to
an
pay
offer at
nearly 100% premium.
135. Henry, they've had a profit warning in September. The share price goes to 71 pence in November. A few days later, after it's 71 pence, they get an offer of 135. Yeah. What, 129 initially, then 135 overall. And they go, nah, no, thank you. We can do better on our own, standalone. They wouldn't open the books. And eventually, on the 12th of December, short and sweet, Lord Rothschild, executive chairman of Volex, commented, it confirms they do not intend to make an offer for TT Electronics. Volex remains resolutely disciplined in how it allocates capital, and applying that principle, we will not proceed with an offer for TT Electronics, as it is now clear the board of TT Electronics is not willing to recommend an offer at an evaluation that is acceptable to Volex. Volex remains confident in its ability to meet full-year expectations and remains focused on delivering its 5-year plan. And the share price actually declined from then on. So TTG responded, Yeah, these are the people that want to remain independent, Henry, do not want to accept 135 versus 79 pence. TTG notes the announcement made by Volex earlier today and that it does not intend to make an offer for TTG. The board continues to have confidence in the company's medium-term financial framework, including the 12% operating margin by 2029, which assumes a reasonable recovery in the components market and is underpinned by the good momentum of our European and Asian businesses, along with the impact of Project Dynamo. The outlook for the company for the year ending the 31st of December 24 is unchanged. There we go.
I'm not sure I buy that, Peter.
Neither do I. So they've got, Henry, they've got their results for the year to be announced in March. So 2 months, just 2 months away,
I
mate.
imagine the shareholders in that are very happy.
They're not going to be happy about it, mate. So you're sitting there, 88 pence, just shy of 89 pence. You were 79 pence pre the takeover. When at its best price, it was priced at 139. Yeah, as a valuation for the company being taken over, and they walked it away. They said no. So their two peers are XP Power at 293 million, Volex at 534, and they're at 160 million right now. I suspect that somebody, if not Volex, is going to come back and have a nibble at that again. And if these results come out in March and they're poor and it goes below 79 pence, they'll once again be they're vulnerable now to another takeover bid. I don't think Volex can come back until May of 2025 at the earliest, if not June, July. But someone else could come back. And if the results are poor, come March, that management team are going to get absolutely spanked by shareholders. If that share price goes below 79 pence, they're going to be in for a world of hurt. Currently, they've got a target price on them from various brokers of £1.48, which is a 66% target price ahead, although I don't really take much notice of those sort of things. Forward PE of 7.9, price to NAV 0.6, turnover is down over the past year of 12.5, earnings per share over the past 3 years is down. Dividend yield of forecast dividend yield 7.7, so you can get paid whilst you wait, and they paid the dividend for the last 14 years, and 4 years of growth on that. So it's one of those, I've got my eye on it regarding the potential for a takeover, but also for the fact that they need to have a catalyst soon. The CEO's been with them. Got a new CEO. I did have the name somewhere. I think it's Peter France. If I got my bearings right, or my names and the other stuff right.
It is. It's
been there since October. Yeah, been there since 23. October 2023. So he needs to get his act together. Otherwise, he'd be out on his ear. There you go, Henry. Any thoughts?
Not one I'm sure I'd like as a business if it wasn't for the takeover offer. And you've got a really bad habit of dangling these in front of me and going, look at this. They walked away and now look where the price is. Someone could come back. Interestingly, I'd never looked at Volex before. That looks like the far more interesting business to me, and that does look like one I'd be interested in. But I've not done any research on it. So
it's a global business. It's a good size. The Rothschild family, as you know, has got
holdings and holdings.
So they've got good reach. They've got the money. If they're going to be bidding 250 million essentially for TTG, they're going to be looking elsewhere for other entities as well. Will they try and they'd have to offer a 30% premium for somebody like XPP? Does that fit with what they want? That then becomes a £400 million offer for XPP. I don't know. One thing for certain, I don't see Volex being purchased by anybody, because that's their vehicle to do what they want to do in the city.
Yeah.
So yeah.
Nice.
Okay. Last one. I'm going to be whistling this one through as well. And this one popped on my radar because of what happened today, Henry. It's been on my radar for a little while, but today I was like, there we go. I missed it. I didn't have the date in my diary as to when it was coming out. So they came out today. The shares popped 13% to 29.5 pence per share. Company, Henry, is called Centaur Media. And I know you and I have had our fair share of chins and chin-ins with media companies. But Centaur Media is engaged in providing business information, training, and specialist consultancy to select professionals and commercial markets within the marketing and legal professions. The company's segments include XIM and The Lawyer. These segments include premium content, training, advisory, marketing services, events, marketing solutions, and recruitment advertising. The XIM, if I'm pronouncing that right, portfolio brings together its marketing brands to deliver business information and specialist consultancy to the marketing segment and sector. XIM brands includes e-consultancy, which I'm sure you've heard of, influencer intelligence, MW, Mini MBA, Marketing Week, the Festival of Marketing, Oysters Catcher, never heard of that, Fashion and Beauty Monitor, Foresight News, and Creative Review. The Lawyer is a provider of intelligence to the global legal market, delivered by scalable digital platform. Yeah. And today, Henry, they came out and said, you know what, given the prior profit warning that we gave you and shocked you with, we're now trading ahead. The board now expects revenue for the 24 calendar to be around 35 million and adjusted EBITDA margin to be approximately 16%. So well ahead. Full year close is better than expected. Year-end trading points to revenue, as I said, of 35 million, which is ahead of their earlier modelling and management guidance, 34. Strong revenue performance from The Lawyer, plus 7%, MW Mini, MBA, plus 5%. And basically, everything seems to be, you know, I don't want to say it's bottom, but they seem to be getting back into the actual groove. So the trading updates points to a slight improvement in the final weeks of the year, given some previous pullback. And for now, they seem to be creating a little bit of confidence behind the shares. No one was expecting that, I don't think, to come out, given they only profit warned a little while back. So that's one I would like to share with you. Interestingly, Richard Staveley of Rockwood Strategic and Harwood Capital has been a big fan of Centaur Media for some time. So I think he's probably relieved that the shares had a pop today, given the performance has been pretty woeful for CAU for quite some time. Other shareholders include Aberforth Partners. Harwood's got 28.96%. Aberforth Partners has got 14.5%. Herald Investment Management, who are involved in this cyber capital stuff, which we haven't spoken about on this pod, has got 7.1%. So got a few shrewdies involved in the actual stock. So interesting sort of company to keep an eye on, I think. Any thoughts? You've got that sinister smile as if say, what a POS stock this is.
Well,
go on,
you shot it yourself before I had to, Peter. What a dog of a company.
You've got a certain tell on your face, Henry, like a poker tell. I need to play you at poker at some point, because I think I'd take your money standing on my head, mate.
You'd be surprised. My Uncle Derek ended up paying me 1,200 quid in 20 minutes at Christmas.
Wow. Maybe not then. Change my mind. Okay,
the
backing
problem
out.
He kept going all in. Fortunately, we were just playing for matchsticks, so...
Oh, okay.
I've got 1,200 quid's worth of matchsticks on the way. I don't know what I'm going to do with them. But anyway, to come back to the shares, I do not like this company at all.
Go for it. Rip it apart, mate. Save some people some research.
Well, forecasts are dire. We're looking at a 60% drop in earnings per share. We're looking at a 10% drop in turnover. We're looking at a 50% drop in pre-tax profit. The return on capital is 13.5%. It's all right. Not going to blow your brains out, but blow the lights out even. But it's got a 3-year average of 1.8%. So they're going to take your money, they're going to produce all this media, and they're going to make 1% doing it. Not that impressive. And then you've got the headwinds with the general sector itself. I mean, media is going through some terrifically difficult times, and I don't think it's going to get any easier with AI. These chat generative AI platforms are stripping so much content off the internet and spewing it back out at such speed now. I don't know where the publishing industry is going to be in another couple of years, and to me, this business is, it's definitely at the high risk end of the risky satellite strategy. So it could recover if you look at the technicals. It's formed what I think they call a bowl. I hear people talking about bowls on social media.
You're not allowed to mention bowls. You're not allowed to mention bowls on this program, mate.
The holy
call
bowling.
It something else, but don't call it that.
It's synonymous with 30% this year. Where they're going to go, I mean, the volatility is just eye-watering on this. If you were on a roller coaster, I think your head would have flown off by now. So, yeah, not one for me, I think, Peter.
Yeah, don't hold back. You're quite finished with your assassination.
Yeah.
Listen, mate, I'm just bringing it to the fore for research. Richard Staveley of Rock Strategic is meant to be a really, really good investor. Harwood Capital are meant to be really, really good investors. Yeah. They've been fans of the stock for years. Maybe it will have a catalyst at some point. Maybe this is the beginning of it. I don't know.
I don't know. I'm just putting it out there.
Just put it out there and say, go and research it. Go and research it. A lot of my companies that I ask you guys to go, and ladies and gents, to go away and research, end up being stuff that you go, I'm never going to go and look there again. However, occasionally I get the odd one right, and we get the odd one right. These are just ideas. We're just trying to just generate ideas for you, good people, to go away and have a look at. And hopefully, I think there was Ryan, Sean, John, and David, various different places came to me and said, thank you ever so much, Pete, for that conversation you had regarding Persimmon. And they all bought it on the day of the announcement last week. And they're all up between 5 and 10% ish on that trading update. And guess who else bought it on the day of the announcement?
You didn't.
Not me.
Oh.
I've been watching it forever. Did I buy it? I was like, that's okay. Mate. But the results are okay, but I want a bit more. And I watched it on the day of the trade. I was like, it's gone. It's gone.
It's taken off again.
Carrying on. And I'm looking at it now. It's already at 12 quid. It was at £10.50, mate, the day before. It's already at 12 quid. Did I buy it? I've been told everybody I'm going to be seizing that. I'm going to be on it like a car bonnet. That when that catalyst comes, I was like, I want a bit more. It's gone. Gone already. Gone already. Anyway, I'm glad four people came back to me and said thank you very much for Persimmon. Long may it continue higher for all of you. And every now and then I get the odd one right. So we'll see what happens, Henry. I'm hoping, Henry, is recording this on the 22nd. I'm hoping tomorrow, the 23rd, that we get some news regarding Renewi and Macquarie coming back with the £8.70 bid and saying, we confirm we're going to take it over. And if that happens, I'll be very, very happy indeed, regarding it being my 60th or 61st takeover for the year.
This Twin Petes investing podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Well, I was just going to say a huge thank you to everybody that's tuned in, and a huge thank you to everybody that's written in so far this year, and also that's entered the competition. Peter and I are busy collating all the data for that, building the spreadsheets, and we'll be able to start running that competition in February and announce the January winner for you. And I'd just like to say thank you as well to you, Peter, for coming on full of cold, suffering through me for an hour, and making sure we have episode 145 on the air, ready to go for our audience, because I couldn't do it without you, mate.
That's very kind of you, sir. I couldn't do it without you either. It's a bit of a challenging day. I'm sorry for coughing and spluttering over that. I'm hoping some people don't listen whilst they're driving, because they'll be getting like that, like a little jolt every now and then, with me spluttering all over the mic for this one. But equally, with regarding what you said, Henry, thank you. Thank you to everybody that supports the pod. If you can subscribe on YouTube and the platforms that you're on, if you can reshare it on the platforms that you're on, including X and Blue Sky, please do so. If there's something that Henry and I have shared regarding the pod that you enjoyed, please tell us regarding giving us some feedback on whatever channel you're on. And if there's something we said on the pod that you disagree with, let us know. And if there's something you think we can improve regarding the pod, please let us know. That's how we've gotten to the stage that we're at. First pod was November 20, I think we're 18. So we're coming up what will be the 7th year this year. We just had our 6th year of running this pod, and Henry's been on with us now for a year and a bit. And this is the way it's going to stay now. We're going to have some really, really brilliant guests going forward as well. Going to shake it up a little bit. Going to get some professionals as well, some city individuals as well regarding the pod, as well as some newbies and experienced and inexperienced investors that want to have a chat with us. We're trying to keep it so that everybody can learn from somebody. That's the way we want to keep it. Oakley dokley. That's a wrap, Henry.
Happy days, mate.
Yeah. You good? Okie dokie. Ladies and gents, thank you ever so much for listening to podcast 145. We will see you, I think it will be February when we see you next. Until then, take care. God bless. Show some kindness and do what you can for others. Lots of love.